Adam, I'll come to you first for your take on what we've seen this week. Clearly a nice bounce yesterday, but week to date down fairly sharply for tech stocks.
I think when people think the Fed might act more aggressively, it causes a bit more of a rotation. But frankly, I'm pretty bullish on equities. I don't think there's a lot of evidence that if they raise interest rates, the stock market goes down. And frankly, I don't think they're going to raise the 3 times that might currently be priced in. So I think there's plenty of things you can buy on weakness.
Katie, what do you think in the short term is the sector you want people to avoid most of all?
You know, in terms of avoiding a sector, I would say it's probably industrials and communication services. Those still are in downtrends relative to the S&P 500. And I keep looking for some signs of downside exhaustion, and they're not quite there yet. Encompassed, of course, in industrials are the transports, which look a little bit better than I'd say average. But those have been the most beleaguered setups that we've come across. That doesn't mean we wouldn't be reducing exposure to stocks that have overbought downturns, of which there's a lot more of those over the last weeks or so than we've seen of late. And this pullback that we've seen in software, as one example, since November is differentiated negatively from the one in September, because when you look at the long-term charts, you're starting to see some signs of exhaustion there that could carry us into a corrective phase, more likely mid-January or beyond.
Adam, do you think we're going into a significant inflationary environment, and how's the best way to play that?
I really don't think so.
Oh, sorry. Go ahead.
Go ahead, Adam.
Yeah, sorry. I really don't think so. I think that there's some things that have changed from 2019, some deglobalization trends, perhaps, maybe some sustained fiscal stimulus in various areas. I tend to think, the job really is to figure out what's mispriced relative to the probabilities. I agree with the industrials underweight. I think a lot of the machinery and capital goods stocks have very optimistic earnings estimates and probably can't pass on pricing. There's, of course, some good industrials, Carrier or others that are great, well-run companies, but I think generally they have high incremental margin expectations. That makes me more cautious. I think you have to own the businesses that are either growth businesses that actually have positive free cash flow and pricing power, healthcare services, maybe the large banks, and energy. Those are kind of how we're thinking about it. The pricing power part I just want to hit on because I'm a small business. I think about who I pay in my business, and I pay Salesforce.com, I pay Microsoft, I pay ADP, I pay UNH, I pay SPGI for data. All those companies have pricing power over me, so when they go down, I tend to like them more.
Adam, they might be watching you. I don't think you should make that too obvious.
What am I going to do? What am I going to do? I think that's the point, right? They have pricing power, and I think that makes their earnings expectations probably more achievable.